This is Wealth BT, a podcast of BT correspondents.
Welcome to Wealth BT, a podcast of BT correspondents, hosted by Genevieve Cua. In this episode, find out how anticipating medium and long-term trends can help you to become a better investor. This episode is produced in collaboration with Pictet Wealth Management.
So far, 2025 feels like a storm has swept through, or several storms. There was Liberation Day tariffs, then a market plunge, and since then stocks have shot up. Plus, the U.S. Federal Reserve has just reduced interest rates by 25 basis points. After all the hand-wringing over the death of U.S. exceptionalism, U.S. stocks are scaling new peaks. What is happening and where are we in the cycle? I believe it helps to step back and take stock. What are market events telling us in the context of long-run trends? How can anticipating the medium and long-term trends help us to become better investors? Most of all, how do we position our portfolio so it's not buffeted by every abrupt turn in the market? Welcome to Wealth BT. I'm Genevieve Cua, Wealth Editor of the Business Times. Every week, my colleagues and I break down a business story that matters. My guest in this episode is Alexandre Tavazzi, who joins us from Geneva. He is Pictet Wealth Management's head of CIO office and macro research. Thanks for spending some time with us, Alexandre.
Thank you for having me.
Let's get into it. Pictet has just published its annual Horizon report, now in its 13th year. It reflects long-term capital market assumptions. Why does the firm publish this, and how can investors use it?
When it comes to long-term thinking, this is what is driving your long-term asset allocation, which drives about 80 to 90% of a portfolio's returns. So being rightly positioned according to what we see for the coming 10 years is absolutely crucial for us, for our clients, and for the way we interact with our clients. Because when they come to us, there are specific requirements, expectations, and the long-term asset allocation is what allows us to match those expectations, which what we think the markets will be able to deliver. Every year when we publish Horizon, it's a thinking process for us, whether we need to change the strategic asset allocation. And if indeed the world is changing, then we need to change the asset allocation. This is then reflected in all the discussions we have with our clients, but especially in the portfolio structures that we manage on behalf of our clients.
So I noticed going through such reports, and not just from Pictet, that the return projections for various asset classes are adjusted almost every year. What drives shifts in these assumptions that are reflected in Horizon this year?
The key essence of what we do is to try to have a clear view about what growth will be in the coming 10 years and what inflation will be in the coming 10 years. Because if you take the real growth rate and you add on inflation, then you have the nominal growth rate for each country. The nominal growth rate is what is driving the earnings of the companies that are listed on the market. So what is nominal growth rate going to look like? The second element, which is very present now as we talk about the tariffs, is inflation. If inflation comes in, doesn't come in, it has huge implication for the interest rate environment. Interest rates were not an issue in the last 10, 15 years because post-Lehman Brothers failure and the great financial crisis, interest rates were down to zero. But in the last 3 years, inflation has come back on the back of reopening post-pandemic, shortage of labor, reorganization of supply chains. So that has become a key issue as well when you want to forecast the coming 10 years. And it has implications of where you want to invest, whether in equities, whether in bonds, or whether in other assets.
The latest report talks about tectonic shifts, which suggests groundbreaking changes with many ripple effects, probably over the long term. U.S. tariffs are an obvious trigger, but what trends have been set off in the markets?
The trend started 2 or 3 years ago because in a post-pandemic world, when everything reopened, inflation came back. Because during the pandemic, U.S. consumers got a lot of cash given to them by the government, and the cash started to enter the economy when the economy started to recover. So the demand-supply issue was not the same anymore. And as we have seen in many countries, inflation became one key issue. But you have other long-term issues that we have to deal with. Demographics is becoming an issue for many countries. The labor force pricing becomes an issue. The availability of labor becomes an issue. And the reaction from the companies is, number one, they have hesitated to maybe reduce labor as much as they used to do in previous cycles. But second, and most important, labor has regained pricing power in the negotiation with companies, and labor has a price today. Meanwhile, we're all obsessed by the tariffs. The key issue is behind the tariffs, because the tariffs is about the US trying to diminish the current account or the trade surplus that many countries have with the US. But those countries were the ones providing financing to the US, recycling those surpluses into US equities or US bonds. So when you say to those countries that maybe with the new tariffs their surplus is going to diminish, in a way, you're touching a key issue, which is how the US is going to finance its debt going forward, knowing that the fiscal deficit will keep increasing.
There's a big theme that I noticed in the horizon about a retreat or retrenchment in terms of globalization. So what are the implications here?
They're huge. Number one, as we have seen, every country is trying to weaponize whatever assets or whatever advantage they have over the rest of the world. For some countries, it is key minerals. For some other countries, it would be oil or energy. For the US, it is what happens with their debt. Remember, we had a famous Miran report, the Mar-a-Lago report, which was saying that maybe foreigners should be taxed on the coupons that they receive on US bonds, on the dividends that they have in US equities, for the privilege of staying invested in the US. So everyone basically is trying to do the best with what we have. And we have moved from a world where the world was global, where it was a multilateral world, to a world that becomes bilateral, a world that becomes completely split, where everyone is trying to, again, fight against the other ones. And we are coming to a world where everyone is bargaining one for one what they have versus what other countries have. This has huge implications because it makes the world less efficient. It makes for companies life more difficult for them to operate in such a world. We know that they had to reorganize their supply chains post the pandemic world because a lot of companies discovered that they could not depend just on one place for their production and then ship the production to the selling places. And especially after the tariffs now, you have a second thinking in terms of where do I need to reroute my exports to the US so that I get the least amount of the tariffs. For companies, it has a cost. So key ingredients which are becoming more expensive. But the operational aspect of all of that is much more complicated because companies have to reorganize the places where they produce. They have to have a plan B in case anything happens. And as we said, they have to now rethink what is the route by which I continue to export to the US. So the whole world is becoming more complicated, more expensive. In the end, the price has to be paid by someone. It could be the companies absorbing part of this increase in their operational costs through their cost structure, but in the end, probably some companies would like to make the customers pay, whether this is other companies, whether this is consumers, and hence we're coming to a world in which inflation becomes structurally higher because of this environment that has completely changed.
So inflation you see as a structural trend. And yet today, the Fed, for example, is still trying to balance where rates are, how endemic is inflation. And there are people who dismiss this to say that, oh, this is a one-off base effect. Do you think people are still underpricing or underestimating the risk of this?
I think it all depends on what level of inflation we talk about. As you know, inflation was a non-issue before the pandemic. Inflation was basically close to zero. All central banks were basically trying to push inflation to get to the 2% target. And if anything, inflation was not existent. And this is why we had very loose monetary policies. Now you just have the reverse. Inflation is a natural state of affairs. If we move into a world pre-Lehman Brothers, pre the great financial crisis, inflation was between 2 and 3%. That, I would say, is a normal state of affairs. Firms can operate when inflation is at 2 or 3%. Firms can eventually raise prices gradually, and this is okay. I think moving from a world where post-pandemic, in some countries you have inflation going as high as 8 to 11%, developed countries, which is absolutely huge. It has come down, and the key issue for now is, well, number one, we don't know the end game of the tariffs because, as you know, China has not yet finalized the negotiations with the US, and China is a big exporter to the US. And second, we had a very specific aspect in terms of corporate management. In the first quarter of this year, a lot of US companies decided to import as much as possible in terms of goods so that they could restock ahead of the tariff day, which was April 2nd. When we listen to the companies, they say, so far so good because we could reduce the stock, we could sell the inventories that we already have. The question will come when we restock for the fall and the winter. At that time, most probably, the tariffs will kick in, and in some way, we will have to push that to our customers. So we don't know the end game yet, but the risk is that starting from a pretty low level today, then you will start to have good prices moving higher on the back of the companies passing on the higher cost to their customers. It could be a one-off, but frankly, we don't know because other things will kick in 2026. We have the big, beautiful bill, which will come in effect in 2026. That's a positive aspect for the US economy. So you may see the economy reaccelerating, inflation moving higher. And then when we talk about long-term trends, you have a very specific issue with the US consumers today. 40% of the US consumption is being made by the top 20% of earners. Those earners today do not depend so much on their wages, but they have a very high wealth effect, which is coming from the rise in the S&P 500. So in essence, even if the labor market eventually cools down, you have a very strong wealth effect that tends to support consumption, and maybe this is going to make inflation less flexible in the current cycle compared to what we have been used to in previous cycles.
Still to come. What stance should you take in the face of these major shifts underway? How can you ensure that you're profiting and not losing too much from positions that may turn bad?
And now back to Wealth BT in collaboration with Pictet Wealth Management.
Welcome back. Alexandre, we've just been discussing some major shifts. What do you see as some of their short and longer-term manifestations? Let's tackle U.S. exceptionalism first. Is this dead? Or, on the other hand, I've just spoken to some companies that say, there's no other alternative.
That is very interesting because Europe is waking up. If I look at the rest of the world, the situation 6 months ago, before Mr. Trump was elected, was really that US was at the top of the top, technological, science, positioning, everything was going in the favor of the US. And this is why in the last 10 to 15 years, there's been so much capital being invested in the US, because let's face it, the US was providing investors with, number one, the best assets, the S&P 500, driven by a lot of technological movements and new development in technology. And second, a safe place. Remember that the US, we've all been raised in this industry talking about the risk-free rate, which is basically the short-term US interest rates. Things have started to change because on the technological side, you're starting to see China more and more challenging the US position, China emerging with their own semiconductor production, cloud ecosystem, spending sometimes 90% less than the US for the same technologies. So you're starting to see alternatives elsewhere for global investors who want to invest in technology. And second, when J.D. Vance was in Munich in February and basically said to European countries, you have to walk alone, it's your call. Now, if you want to move up, Germany, for which debt is like a sin, has decided to basically break the debt break rule that was in the constitution. And Germany has decided to put 500 billion euros on the table to renew its infrastructure. And collectively, European NATO nations have decided to move up to 3.5% of GDP in investing in defense. So Europe has woken up to what has taken place. So for investors who used to look at the US as the only place where you could invest, then you're starting to see other alternatives emerging elsewhere. And on the debt side, the fact that the US is starting to tax its allies, tax or with tariffs countries that used to invest a lot of their surplus into the US bond and equity market, that new attitude is also meaning that the countries have to think twice, where do I invest? Is the US risk-free rate still as risk-free as it used to be? Do I have the alternatives elsewhere? And the victim of all of that, as we have seen so far this year, was the dollar, because people have thought twice about the allocation to US dollar assets. And this is why, from the year-to-date basis, dollar is down about 10%. And if you wish, the anti-dollar protection, which could be represented by gold, is up by 45% this year. People are not moving away from the US, but they're thinking twice about their currency allocation, especially when it comes to the US dollar.
So I guess this relates to the concerns about the U.S. fiscal position and the big, beautiful bill. What are your thoughts here? Especially Asian clients a lot of their portfolios are in US dollar. Not just the asset classes are in US dollar, but it's just their favored currency.
True. The message that we are conveying to our clients, given those long-term changes and given that the US position is not as unique as it used to be, remember, when Germany decides to invest in its own country, then they will have to issue about 800 billions worth of euros on the market. So you have a debt from a country which is financially sound at interesting interest rates, which is appearing. So the message we're conveying to our US clients is to look for diversification, maybe to be less US dollar centric. The reasons why the US equity market is where it is, because you have amazingly profitable companies. But when it comes to the bond market, indeed, what we have seen from the year-to-date basis is the following one. The short end of the yield curve is held low by the Fed, and as we all know, there's a strong pressure from Mr. Trump to try to engineer a cut in interest rates. So the short end will start to come down. But the long end is resisting because the long end is where all of those fiscal worries, inflation worries are taking place. So what you see is a steepening of the yield curve. So for investors who continue to want to be invested in the US bond market, don't go too far in terms of duration. Stay from 3 months to 5 years, because this is where we think the risk reward makes sense. For longer dated bonds, probably if you look at the premium you get to invest on a 10-year US Treasury bond as opposed to a 1 year and repeat that for 10 years, the premium you get as an investor is not sufficient enough for us to tell our clients this is the best part of the bond market. So we say to our clients, look for diversification. Things are interesting elsewhere, and maybe Europe and other countries are appearing on the radar of many of our clients. And when it comes to the US bond market, which should be reflecting the fiscal issue, don't go too long. And second, of course, whatever is being done in the US has to be seen with two angles. Number one, US needs new revenues to compensate for the decline in fiscal revenues, which is a result of the BBB bill, hence the tariffs. The tariffs are very important because they bring your revenues in. And second, and most important, the way the pressure is being applied on the Fed is to try to avoid that whatever new debt is going to be issued will not cost too much for the US Treasury. So our reaction is diversify, maybe there are chances to find attractive investments elsewhere, and maybe be careful with the duration on your fixed income portfolio.
So I'd like to take you up on something you mentioned, multilateralism, and how countries are weaponizing some assets that they have. So from there, I'd like to get some views on Asia. What do you think are the opportunities in Asia? And China, as you know, has critical minerals.
We really have moved into a transactional world where everyone is trying to basically deal or transact with other countries. And of course, the US is at the center of all of this. When it comes to China, you really have a two-sided economy today. The side which is still under repair or that needs to be helped further is probably what is related to property, because this is still not recovering enough. Property is important because this is driving consumer sentiment and hence consumption. So this is the part that is need to be supported, and probably more to come here. But what is happening on the other side is that some industries have become key to the next phase of growth of the Chinese economy: renewable energies, technology. Because remember, Trump, in his first term, was the one who decided to limit the export of semiconductors to China. Biden increased even more the restrictions, to the point where the Chinese authorities decided to invest on their own in their own semiconductor ecosystem, cloud ecosystem. And this is now starting to emerge, but it started 8 years ago. More and more Chinese companies are developing their own ecosystem. And when we think about horizon, when we think about the coming 5 to 10 years, maybe the world will have to choose in the coming years, where today we're used to the US-centric ecosystem on the technology, but maybe 5 years from now, we'll have the same equivalent from the Chinese side, and people and companies will have to decide where to go, basically. And that's a way also for China to probably offer that type of technology to countries which are less aligned with the US than what they are today. So that is, I would say, one side of the investment, which is also interesting because you see high growth in those areas. When it comes to other countries in Asia, they are the ones in a way benefiting indirectly from what is taking place, because they are the ones who can produce what China will not be producing anymore. Some of the materials will be reshipped from them and then re-exported to the US. And then demographics in Asia and Southeast Asia is one of the areas where you do have a rise in population, if we exclude, of course, China, which has another issue. So you do have wealth creation, really emergence of a new consumer. And those countries are within the same trade agreement, which is called RCEP, which was signed a few years ago, which should allow them to trade among themselves in terms of tariff-free. So this should be helpful to those countries as well.
Horizon mentions quite a few mega trends. You've mentioned one, which is demographics. There's also digital decoupling. If you were to pick one or two of the most pivotal trends, what would they be?
Demographics, definitely, because it's hurting almost everyone. Demographics is driving AI in a sense, because if we don't have productivity gains today, demographics is going to play a big role in terms of which countries will be able to grow at the same pace as what you have today. Demographics plays a big role as well, because ultimately governments or the active workers will have to pay for the people who go into retirement. So that is going to be another issue in terms of government financial situation and, of course, the fiscal situation. We have mentioned, of course, technology is in a way linked to that, but not only. Technology is becoming now the oil of the last 50 years. Technology, semiconductors today, is what everyone wants to have. Because if you have the high level of technology, you can develop AI. You can gain productivity on the production. But you also gain military power, because it's all about technology today. So if you don't have that, you're weak in terms of economic trends, in terms of being able to improve your productivity, but also on the military side. And last and not least, renewable energies. This is a key technology today, because as we all live, extreme events from the weather are happening more and more frequently. Amplitude of these events, they're just increasing. So far, we have not seen any major financial aspect, but typically, if you think about an insurance company, at some point, where do we see a point where some insurance company says to a company, this asset over there, I'm not able to insure that anymore because it's too costly. That may come in the future. So we really have to continue to invest in those technologies. And we have to make sure that the companies go along those sides as well. So these are really, I think, the big trends that we have to be careful about.
Thanks for your insights.
You're very welcome.
I hope this episode has helped you to put events into perspective. Remember, asset allocation is the most important decision you make for your long-term portfolio and financial goals. Being diversified helps to keep your overall exposures on an even keel. Most of all, your strategic allocation gives you a rationale for staying invested and helps to keep emotions in check. BT Correspondents will be back next week with an episode on transport. So until next time, I'm Genevieve Cua. Thank you for listening.
This episode of Wealth BT was produced in collaboration with Pictet Wealth Management.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.